All right, cool. So let's start it up. Um, so the reason that we're hosting this space is to kind of open up a broader discussion around like what is the history of AMMs, why did they become so popular, why were they successful, why don't we see order books being successful, given that's kind of how the order flow works in a traditional stock exchange, and like basically like why don't those work on in Web3? Why can't we just port over the model from Web2 into Web3? And one of the problems that we constantly run into is on-chain storage. Like the cost of on-chain storage at current ETH prices is something like 20 million gigs, or $20 million per gigabyte. So imagine just trying to store data of all these orders on chain, and just like the tremendous gas cost for market makers that are constantly canceling orders, creating new orders, that becomes very costly. And that's kind of why you saw a lot of these DEXs, which initially kind of function like order books, like Ether Delta and IDEX. Those guys would actually use signed messages, so that the creation of orders was free. At least the canceling is not, and can never be free, because you have to basically write state on chain to say, hey, this signed message is no longer valid. So this has been a huge problem for a long time, like definitely a problem that we're looking to solve with Pool Sharks. So basically what we're building is a, first price priority and then time priority. So if there's two people at the same price, well, it'll be the market maker that got there first, they'll actually get the fees. So we kind of think this opens up like a whole new paradigm in terms of market making. But before we get to that, we're going to talk about AMMs and why they've been successful up to this point, and like how at least I think that they can continue to be successful. If anybody has any questions at any point during this space, like feel free to raise your hand or request to speak, and we will bring you up on stage. So what is an AMM? Well, it's an automated market maker that has, in this case, a curve, that adjusts based on the amount of supply, the reserves of either token that's in the pool. And so basically liquidity, when you supply liquidity to Uniswap, you're supplying it starting at the current price, one side of the token pair going all the way down to zero, and then the other side going all the way up to infinity. So like in V2, in Uniswap V2, you're supplying liquidity across an entire price range. And so you have a single curve that represents everybody in the pool. And that's why you were able to mint ERC20s, deposit in a vault, get some yield, all that good stuff from Uniswap V2. Whereas V3, you have an NFT because it's customized. Like everybody has their own curve, right? Just like in an NFT collection, everybody has their own JPEG. So that's kind of been the evolution from going from V2 to V3. And Arrakis is here to kind of talk about what they're doing around V3 liquidity optimization to make it work for everybody, because definitely there's a huge technical limitation, at least initially, for people that are trying to get onto Uniswap V3. I think definitely in terms of the cost of providing the liquidity position. And I think the really cool thing about Arrakis is that basically you just transfer your tokens into this vault. It gives you a vault token back. And I think for people that are new to Uniswap V3, this is a really great way to kind of break into it and understand what's going on, because kind of the way that I've educated myself has always been just, set up a wallet, get $20, go play around with the protocol and see what happens. So yeah, Kassandra, why don't you introduce yourself and talk about what you guys are doing at Arrakis?
Yeah, sure. Hey, everybody. I'm Kassandra. I'm sort of the technical lead of the Arrakis project. And I've spent the last year as a smart contract developer really deep diving into Uniswap v3. So this is my domain that I understand well. In the process, I feel like I've learned a little bit more about the general liquidity landscape and some of what this history of market making when it moved on chain, and what has happened, what does it mean, are AMMs the future, or are they just right now a gas optimization, all this stuff. But that's sort of on the side. My real expertise is actually just hacking on top of Uniswap v3. So yeah, I think I want to echo what I just heard about, I mean, AMMs are a really new concept. I think it's important to remember that. I think, there was maybe some very technical, very obtuse, more like academic literature about some of these ideas, constant function, market makers and stuff, but they were never put into practice, and no one ever thought they would really work and scale until until Uniswap and the explosion of Uniswap v2 like decentralized exchanges. So I think just setting the scene, right, this is very important to remember that while it proliferated itself extremely fast, right, and now everybody knows about LPing and LP tokens and and specifically these Uniswap v2 style dexes, this is only like a few year old innovation. And the chains themselves are changing. You hear a lot of things about like what is the future of market making and of liquid markets on chain, and it's very possible that maybe it will still look very different than what it looks like today as these chains evolve, as like gas, the amount that people have to pay in fees just in order to interact with these protocols goes down. We might see more order books come back into popularity again in the future. So I think one of the most interesting questions to me while we're talking about this broad stuff of history of AMMs is trying to understand whether or not automated market makers are kind of the future of market making forever and ever, or whether they're this interlude while that's really just an optimization to make it efficient to do on chain for now, and that actually in the future they're going to continue to evolve and eventually maybe look a lot more like order books, right? Because if you're working on layer 2 Starknet, yes, maybe gas costs are completely prohibitive to do the entire to put everything about everyone's orders and canceling and etc. on chain, right? This is not possible today, but will this be possible in the future? I don't know, right? So yeah, sorry, I know that's very zoomed out, but my questions are really from in terms of the history part, right? What I would love to zoom in on is what are the benefits and the drawbacks of the AMM design. And I think it's quite interesting I would think most of the people here and in general, people deep into crypto and like crypto markets understand LPing on UniV2. But what is UniV3? Because this kind of shook up the whole AMM space. Originally there was kind of one idea, this constant product market maker, and everybody jumped on board and everybody thought, okay, this is the future of liquidity provision, right? But only a few years later now it's completely fractured, and already there's totally new paradigms with V3. So yeah, maybe hopefully today we'll be able to talk about some of these things and see if we can dive in and understand a little bit what's really going on here in terms of how market making works and how it will continue to make work in the future on chain.
Yeah, I think that's a really good like kind of precedent to set. It's like to think about where we've been and what is it going to be in a few years. Like one of the things that I reflect on a lot is just like, entering all these like yield farms. You provide liquidity on some token for God knows what reason, and then like, oh, I'm getting this yield, right? But I think that was kind of the ploy that a lot of us got pulled into. And like something that I've just realized about Uniswap is like the goal is not to like, I think a lot of us have the misconception that liquidity providing is to like get extra gains on top of your gains. And like I would love to hear if other people kind of feel that same way, but I feel like that's always been the way that it's kind of like been sold and marketed to me. And I think that's only true if you can avoid impermanent loss. Basically, if that yield is outpacing your impermanent loss, which is something that's like really hard to gauge, right? And I think that you know, though the impermanent loss is a risk, there's the trade-off of you're supplying the liquidity at the market price, right? Based on the ratio of liquidity that's there. And you know, in the V3 model where you can concentrate that around a specific price range, you can trade more near the market price and collect more fees, you know, with the trade-off of having the permanent loss. And like, of course, I think it's really important to note that you can always just mirror the Uniswap V2 model in V3, but everybody in the pool is able to express their opinion of what price range they want to, you know, provide trades around.
Yes.
So I think V3 is really cool in that sense, is that because of this NFT, you're allowed to have an opinion on what you think the optimal curve is.
Exactly, right. And the cool thing is expressing a new degree of freedom. We used to have one curve, right? This constant product curve, and it looked like, you know, it's kind of has a hyperbolic shape so that you never run out of either asset, even if the price really, really swings in one direction. You all, that's like the function. That's the reason this curve that we have on Uniswap works well. But in UniV3, basically everybody gets to express their opinion, as you said, about the price range that they think these assets might be trading in. And then when you aggregate all these ranges together, you get a new curve, right? You construct a specific curve for each market about how the price will move as traders trade a certain amount of one asset for the other, which is the aggregation of everybody's non-fungible opinions, right? But I think also it's really, if we're talking about the history of DEXs and just order books and AMMs, it's really important to remember, to just go way back to the beginning, maybe, why are we doing this? And I agree with what you said, right? A lot of people understand liquidity providing right now as a yield generating game or idea. But this isn't necessarily the case, right? It's worth remembering that what it's really about is making the market for these two tokens, or these two assets, liquid. This is what matters, and whether or not this is profitable is actually not what these market constructions and structures are about. That's a side product. Maybe someone can find profitability there. Maybe you'll lose all your money there. But what these things are trying to do is make it so that there is liquidity, so that then you can seamlessly trade one token into another. And it's not necessarily about the LP's profits. And you can see that Uniswap V3 in no way optimizes for LP profitability. In fact, there's so much literature right now about people just getting wrecked on UniV3. And people say, oh, that means UniV3 is bad. But in my opinion, not necessarily, right? Because at the end of the day, what they're trying to do is not give liquidity providers a lot of profits, but make highly liquid markets. And UniV3 is an incredibly liquid market with great trade execution prices, whether or not it optimizes for the LPs. And so I guess maybe to rope that back to Arrakis, it's like, I think because LP profitability is not what's optimized for at the lowest layer of the DEX, and potentially that's okay, Arrakis is here to try to do that on top. So if you're just a liquidity provider, maybe you understand markets and market making very sophisticatedly, then potentially you can extract profits by providing liquidity to these markets. But if you're not a market making expert and a professional in how to understand these different markets on these different trading pairs, then extracting profits isn't as simple as just provide your assets, right? Which was what was so exciting about the explosion of UniV2, though, as you say, there actually wasn't that much necessarily profit, right? People still got potentially wrecked doing some liquidity mining on a token that was headed to zero, let's say. So what Arrakis is all about is becoming this middle layer, a layer on top of Uniswap v3 that worries specifically about optimizing LP, both profits and optimizing how you distribute this liquidity. So I think it's really important also to note that those, again, are different, right? Some projects are not necessarily worried so much about the profit that their market making is giving them. Again, the chief concern, I think it's so important, is about making the market as liquid as possible. And it's important to remember that and profits are two separate things. This is huge, and I think is something that the crypto sort of amateur LP landscape is missing a lot of. And that's exactly why, right? Pool 2 farming and yield farming exists, where a project will stream you tokens for leaving your liquidity on their pair, aka the project wants to pay you to provide liquidity. So someone is actually willing to spend money, to lose money, so that there's liquidity in the market. And why are they doing this? Because you, as the LP, would probably not turn a profit without these yield farming rewards. And so they want to try to subsidize the losses you might have as an LP with their yield farming. So again, I'm trying to reframe for normal people this misconception that you highlighted, which is providing liquidity is all about making extra money, getting yield, when in fact providing liquidity is about making the market liquid. And sometimes often this means taking on losses. And there is value in markets being liquid, and so there could be something to extract there, but just being the liquidity provider does not mean you're going to make a lot of yield. Sorry, I know I went off on a big tangent there, but I think these are potentially interesting topics.
No, I think that was a really necessary tangent, and like encapsulates the idea of like why impermanent loss is a thing. And it's because people want to make markets liquid, right? Somebody definitely has a financial incentive to go out and make the markets liquid, so people, can trade and do all types of stuff, right? Move around between different assets, trade with minimal slippage, get in and out. This is something that people with big positions or like day traders, they're always looking for that liquidity. Where's the liquidity? Because that's where the trading is going to go. Because you can get in and out with ease, with minimal downside, like when you exit.
Exactly. And so to continue with this, setting the scene as well, it's like, so every stuff that like securities or tokens, stocks or utility tokens, all these different things, they're only useful if they can actually be traded, right? And centralized exchanges and normal order book market making is about the problem of, well, if you didn't have some sort of central market, it would be very hard for buyers and sellers of Tesla stocks and Apple stocks to find each other and say, hey, you have a few Apple stocks you want to sell? Well, I want to sell Tesla stocks, and we make a trade, right? This would never happen, and these markets would never work. So instead, what happened was the invention of exchanges, right? People, market makers saying, you know what? I know there are people who want to buy, there are people who want to sell. I have some of both, so I'll buy and sell, right? And the old-fashioned idea was to say, well, I'll set the prices of what I buy and sell at. And so this centralized market maker gets to decide on their prices, or maybe they set a bunch of limit orders at different prices, and you create this order book style kind of market. Now, The issue with this, and why are decentralized exchanges even popular, is because now you have this central authority who gets to decide what assets have liquidity, can be traded, and every other kind of asset becomes impossible to trade, like all the ICO tokens from 2017, right? You couldn't trade them anywhere, and they all went to zero because they were totally useless as tokens because there was no liquidity anywhere unless you got on a centralized exchange. And so the explosion of excitement around the DEX, even though UniV2 DEX isn't very efficient, is that all these long tail assets could now also bootstrap liquidity without needing to know somebody at Coinbase or spend money to try to find your way onto these very central places where all the market activity was, and you could bootstrap liquidity organically with just anyone who has the assets who wants to risk them to potentially make some additional tokens off of the trading, can do this, and we can bootstrap some liquidity. And what we lost when we went to decentralized exchange and a UniV2 was actually all the efficient pricing, right? The centralized exchanges were really good at setting limit orders right around the current price, and there was really deep liquidity around the current price because they understood how the markets were moving, and we left it to the market makers to figure out prices for everybody. And traders can just decide which exchanges they want to be on. But in UniV2, the price is now automatically figured out by the smart contract. It happens to be wildly inefficient, but just because of this, now we can create our own order book. Or I guess, right, originally we thought, what if we just create our own order books like Ether Delta and IDEX? But that just didn't work because of some of these issues about just how the chain works, right? So once we found a decentralized exchange model that did work very well, there was this explosion of activity, and I think it was all of that activity just has to do with the idea that long tail assets that would never have been on a Coinbase, especially in the old days when it only had like 3 tokens, could now spin up liquidity completely organically without asking anybody's permission.
Yeah, and to kind of get at the heart of why, at least in my mind, the sort of on-chain, off-chain order books didn't work is because you couldn't just say, like, I want 1 million tokens and, here's my slippage range. And it would, basically the way AMMs work is it's fill or kill. Either you can provide that or the DEX can't provide it within that slippage range based on the ratio of tokens. So basically you have these offers in IDEX and Ether Delta, and you have to match on these exact offers. So I think it just becomes very inefficient, from it's one thing that I thought about before we started this space was I actually realized, there is arbitrage opportunities in DEXs that don't exist on these off-chain order books. So let me boil that down a little bit. So, let's say somebody says, I want to sell 32,000 of this token, and they sign an order, goes in some off-chain or on-chain order book, and you're just kind of waiting to sign that offer. And then I say, okay, I'm going to go and sign that offer for 32,000 tokens. Nobody can front run me, and there's no arbitrage opportunity there. But if I say, hey, I want 32,000 tokens within 0.5% slippage, somebody can go and front run me and arbitrage. So I think there's a lot more arbitrage opportunities in DEXs. And I think that has led to a lot more interest in DEXs for that reason. And, why you see the proliferation of MEV searchers, which really is mostly on decentralized exchanges. And like I said, you can't do that in these on-chain, off-chain order books because the liquidity is not aggregated around a certain price. So, again, if
Well-
you say, go ahead.
Yeah, well, I have this question, right? I think the issue, if it was all fully on chain, potentially you could, right? Because somebody, let's say people placed orders that go fully on chain, and the order that I'm willing to trade token X for price Y, you know, or for Y amount of token B. But yeah, let's say I'm willing to trade X amount of token at Y price, and that's way off the current price, and this is on chain, and anyone can like call the fill method, then of course you would have MEV searchers looking for people asking for orders with bad prices, and then you know, filling them by filling that order themselves at a good price and pocketing the difference, right? This is arbitrage, and it would be possible. I think what happens, right, and the issue with the on-chain, off-chain order book is that because you realize it's not efficient to store every single order completely on-chain, like every put and every call, and then have people call on-chain to actually do the matching and filling of these orders. So when you got to this off-chain idea, it's great, except for the problem is, who's got the database of all the signed off-chain orders, and how do they do the preferential treatment of which order goes first, etc. And basically, you give all the MEV over to the central party again, just like a centralized exchange.
Bingo. And that's the exact problem that I see with these hybrid off-chain, on-chain order books. There's always a centralized component, a centralized API. And like, you know, like I've worked on cloud solutions, like in the Amazon cloud, like there's obviously there's benefits to centralizing something so you can have faster access to it. People don't have to pay transaction fees, you know, to make state changes and all that stuff. But I think there's an enforcement of an on-chain ordering of transactions that happens, that when you bring it off-chain, you're losing that effect and that guarantee, because basically, you know, somebody that's running a fiber cable from their house or wherever they are to where
We seem to have lost Alpha Key. There he is. Oh, wait. Can we make him a speaker? I don't have this, I don't think I have that. Alpha Key, you there? Hey, you're back. Sir. Well, while we're here, to not bore everyone, can maybe try to go on until Alpha Key is back. Maybe keeping things super high level if we're still talking about history of AMMs. I think it's just the most interesting trend, and order books. The most interesting trend is we started with the order book model. The idea of the AMM, which was super inefficient, had this explosion of activity because it was not efficient but entirely permissionless, and thus an explosion of activity for everybody at this on this new model and new technique. Except now with Uniswap v3, we're seeing the question is this like the perfect hybrid? It's kind of an AMM, but it looks a lot more like an order book. Or are we just slowly realizing that that we need to go back to the order book model, right? And this is what I find a really interesting question. And just so like the general trend was order books on chain, not very popular. Fully permissionless and simple interfaces, AMMs, extremely popular, not very efficient. And now Uniswap v3, which is moving back towards the order book model, right? these range orders are basically it's just a slight variation on the order book model is what Uniswap v3 is, where you can't set a limit order at a specific price. You can only set orders inside of certain ranges that are predefined for you.
Yeah, and maybe that's a good segue to the thing that we're building, which again, like I think AMMs are great for stable pairs because you can concentrate liquidity around a certain price. You don't need to constantly, like if you know what the price range is going to be, you don't have to constantly increase your operating costs by spending a bunch of gas and like constantly placing orders. But I think when that price range is more sparse, you have impermanent loss. And the tricky thing is like you don't have a lot of data on chain to make really smart decisions, right? Your curve is ultimately impervious to what's happening off chain, which could be other networks, other exchanges. So
hacks, regulation, etc., all this off-chain stuff, sentiment.
Yeah, exactly. So, and there are other common issues that people experience with Uniswap v3, namely maybe you're familiar with like the JIT liquidity, Kassandra.
Of course. Yeah.
Yeah, that being a huge problem. And like I think no matter what, a fully on-chain system, you're gonna have that issue. And I think that's I think that's inherent. Even if you have a private mempool, and like maybe you're probably more educated in how Flashbots works than I do. That's just like I think it's just a private mempool, and the miners, like there's like an auction, like during that auction period, you're able to see what transactions are there, right? So it kind of limits the scope of who can front run.
Yeah, the idea, I think, of Flashbots is to democratize who can front run, basically democratize the searching so that everyone has a line to bribe a miner, not just people who know miners and can be in cahoots with them, which would have been like in the pre-Flashbots days. Like the entities who have the total control over extracting the MEV up until today are miners, right? Because they order the transactions, and MEV is about extracting value by ordering transactions. The thing was, it's a lot of work to find these arbitrage opportunities. So miners and searchers were working together. Like you find the arbitrage opportunities, you give them to me. When I mine a block, we'll split the profits. But this creates very like cartelized sort of network structure. So Flashbots is about making this democratic for everyone. But this isn't really the topic for today. In terms of just-in-time liquidity, it might be interesting to think about, and maybe people in the audience even know, like how this maps on traditional markets and traditional centralized exchanges. But to me, it's similar to like high frequency trading and this same idea about just like placing and canceling orders at the right time. This is basically what just-in-time liquidity is about. And the part of moving through Flashbots is just making it so you don't have to compete with others when you see an opportunity. You can get the arbitrage you found mined privately. Like you say, it's just a private mempool. But to me, just-in-time liquidity is very similar to this kind of centralized market-making activity. The central idea is when you see a big trade coming in, place a bunch of liquidity in the exact tick where the price is right now. And because of how Uniswap v3 works, the more concentrated your liquidity, the more percentage of the fees you get while the trades are happening inside of your active liquidity. By placing all of your liquidity in a single tick whenever a big trade is coming up, you can basically take the lion's share of the fees on that big trade and then remove your liquidity immediately so that you don't expose yourself to exactly the problem you said, which is this off-chain stuff that might make the price drift in the future, right? The longer you leave your liquidity in one of these, UniV2 especially, but in any of these decentralized exchanges with the liquidity pool model, the more risk you have of these impermanent losses. So the idea is to, liquidity providers, they want fees, but they don't want impermanent losses. One really cool way to do this is to, whenever you see a huge trade coming in the mempool, provide liquidity just right now, take all the fees, you want fees, you know exactly how much your impermanent loss you'll get during that trade, and then remove the liquidity immediately so you don't expose yourself to any more price drift.
Yeah, and I think this is one of the problems that I see with AMMs, at least to some extent, from like a market maker side, is that all of those fees are split amongst the pool. Whereas kind of the way that we were looking at it, designing like time ordered market maker, is that basically the first person that's there at a given price would receive all the fees instead of them being split amongst the pool. Of course, like anything that's fully on chain, you still have the front running, someone can undercut you, but at that point someone has to take a loss in the price that they're selling the asset at. So there's, I think the trade-off, it's different, right? I think at the end of the day, AMMs are super well suited for when you have a known price range, because you're always trading at the market price, and so you can collect more fees without placing and canceling all these orders. None of that stuff makes sense for more stable pairs.
Yeah, I think this is a really cool insight, actually, which is AMMs are definitively better on more stable pairs than centralized exchanges, given that you have the Uniswap v3 style model, wherein you can actually specify the price range you'd want to deposit your liquidity in. But yeah, you no longer need to be, placing and canceling tons of orders all the time. You just place that highly concentrated liquidity right around the correlated prices of these two assets, and you don't have to touch it, and you just earn the fees and allow the price to micro drift inside there without really you needing to be active at all. But as you said, I think it's still very similar to an order book. In Uniswap v3 is very similar to an order book in that, yes, it's true that you can still place this liquidity over ranges, and this is exciting, but in the end, if you want it to be highly optimized, you need to place it in a range and then adjust that range as prices move. It's very similar to centralized market makers who place a bunch of limit orders and then cancel them as prices move and place them somewhere else, right? And the more we try to optimize Uni v3 liquidity providing, the more we see that actually the way to do it in an optimal way starts to look very, very much similar to just-in-time liquidity, like placing and canceling limit orders, right? Don't place these wide ranges necessarily. Place a range for a very specific reason for a short amount of time, and then place a new range for a specific reason at a short amount of time. Basically, place limit orders in very thin price ranges, and the only thing is you can't place it at an exact price. You allow the price to drift inside this little range. You don't have limit orders, you have these slightly fat limit orders. This is really the only difference between a limit order book and the range orders of Uni v3, and to me, all liquidity in Uniswap v3 is actually just a range order. Just a limit order that you decide how fat it is, how fat that price range is. So not really a limit order, but yeah.
Yeah, which I think is really cool, and I think it's just a more beautiful way to express market making and movement of prices, as opposed to the very boring and just intimidating looking at this order book, watching all these trades flow in and out. I definitely think there's a group of people, like day traders, that definitely want that. But I think just the average person, I think moving forward, there's going to be like a huge appeal of AMMs to average people, because it feels like a more organic way of settling on a price for something versus, it's still left up to market makers at the end of the day. So, but yeah, the one drawback that I see with range orders is that there's no time priority, and it's something that we're trying to address with the way that we're building. We call it a QMM, so it's a queued market maker, and so the first person to place an order is the first person that gets filled, and traditionally this has always been a problem because in doing this in a gas finite way, because people have always tried to approach it using iterating over a list of orders. So like the computation is not finite. And the way that we solved that was we basically just use a volume counter at a specific price. And so if you come in at when 100 units of volume have moved through and your order size is 100, when the volume counter gets to 200, we know that you got filled. So it's, instead of using price as like in the range orders to tell you when you got filled, we're using a volume counter to do that. And yeah, there's still like a ton of like technical issues to solve, but it's been really exciting. Like we talked to a lot of people at ETH Amsterdam about this, and like people were just really interested in trying to help us like solve this problem of how do we do limit orders fully on chain in a gas finite way. It's like it's a real challenge. And yeah, even with the approach we have for cancels, we still have to worry about somebody's order fitting the gas limit for a block. So yeah, you can imagine we're thinking of all types of solutions.
Yeah,
at this.
It's so interesting, actually. I really think this volume approach that you're taking could be very interesting. And it shows that really everyone has the same problem. All of these AMMs are really solving the exact same problem you are, in my opinion, which is we know what works for markets. It's these central limit order books. The problem is there's a finite amount of gas on chain, and so you can't iterate through all the orders, or you always have this very technical gas limitation. And because of that, you need to find a way to have something that looks as much like a limit order book as you can, but that can aggregate all the information more efficiently. So Uniswap does it by always the price being automatically set at all times and using these ranges now, right? And you're talking about doing it where you let the volume that's passed through be known at all times and thus aggregate the information. But in the end, we're just finding a way to efficiently aggregate all the information from all the orders, from all the buys and sells that people want to do, in such a way that we can fully express this just on chain, but with still fitting inside of all the limitations of the very basic blockchain computer with finite compute space. So I think one thing I've really felt after Uniswap v3, where it sort of makes it known, right? It's almost an order book, just looks a little different so that it all fits on chain. I think we're going to continue to see, like you guys and many others, and people continuing to try to crack the best model for this. And I do not think we're done with AMMs, though I do, of course, I'm very much a Uniswap v3 bull personally, and think it's they saw that this was the true problem and are continuing to innovate, and they're far ahead of others. But I think there's a lot of space to innovate and create these market structures that do this, that aggregate the information of all the limit orders using some nice ideas or abstractions or properties and math in order to make it efficient on chain. But in the end, the more that I think about it, the more I think we're just trying to approximate an order book, but be able to fit it on chain. Sounds like what you're doing, and to me, it sounds like what Uniswap v3 has done.
Yeah, pretty much. And also, like, you were kind of educating me a bit yesterday on how the price ticks work, because I didn't really understand. Well, if you have all these custom NFTs, how does it know how much liquidity there is at different price ticks. And Ari, you can probably explain a lot better than me.
Yeah, exactly. How do we efficiently, right? It's a really interesting, it's kind of technical, I guess, but really interesting model of how is it that Uniswap actually efficiently aggregates all these liquidity providers' preferences, right? Everybody has an upper and a lower price they want to sell their assets at. But how does the Uniswap v3 market figure out how trades move the price based on where all this liquidity is without looping through every single NFT and checking everybody, right? And once you're doing that, you're back at the main problem, right? We don't want to loop over all the orders, over all the puts, over all the liquidity in there. So how do they do this? And you need to use the classic computer science tricks of these kind of like aggregator values and different basically have little checkpoints whenever something happens that then allows you to compute what you need to compute without looping over everything again. And this is all they do. And the way they do it is by, yes, so we have this market with these quantized ticks. And whenever we pass a tick boundary, all we need to know is whether that was the edge of someone's range and now all their liquidity is out of range, or whether that was the edge of someone's range on the other side and now someone's liquidity just comes in range. And so everyone who places liquidity on Uniswap v3, your NFT, right, the non-fungible part, your preference is denoted as your lower tick, your upper tick, and then an amount of liquidity, a number, right? This number and the width of that range can tell you exactly how much assets you've put in, given that how far your lower and upper tick are from each other. So if your lower and upper tick are closer together, you can get a higher liquidity number without putting in as much assets, right? So, but so now that every position has this like special number, how much liquidity, and the lower and upper tick, now we can very efficiently, whenever we cross a tick boundary, understand how much liquidity there is in this new tick that we're in, which is just by adding up the delta, right? So every single position has a certain liquidity amount, and that means and has a tick boundaries at specific ticks. So at every single tick, all we have to do is figure out how much liquidity do we subtract at this tick and how much liquidity do we add at this tick, figuring out how many providers go in range and out of range. So whenever a liquidity provider provides their assets, we just put state on all these irrelevant ticks, and then we can efficiently move the price as orders go through, because all we have to do is it works just like Uniswap v2 inside of any tick. And whenever we cross a tick boundary, we just have to check these deltas to see how much liquidity do we now imagine we have in the market. So it works like Uni v2, except it changes every time we cross a boundary. What this constant product, right, x times y equals k is Uni v2. K just changes whenever we cross a tick boundary, and at every tick we have stored in state how much k should change whenever we cross the boundary. So yeah, sorry, I know it's quite technical. Maybe nobody cares about that aspect. But again, in the end, they're just efficiently aggregating something so that we can handle everybody's, limit puts that they've set there.
Yeah, it makes a lot of sense. And if I understood correctly, correct me if I'm wrong, when I go and provide my liquidity, I have my upper tick and my lower tick. And on the actual pool, it's only going to modify those two ticks, right? It doesn't have to modify
exactly. Yes, exactly right. Yes.
Okay, yeah, that was like the main thing I need to understand, because I'm like, wait, does it have to modify every single tick to create this custom curve? And like, no, it doesn't. It's gas finite in that sense. Cool. So I guess now we can open it up for Q&A if anybody has any questions. I saw one guy, I think he was from Protocol Labs. He tried to jump up on stage. If anybody wants to ask a question or like put forward a thought or like a talking point, feel free.
Yeah, while we're waiting here, one thing that I find super interesting though please interrupt me if anybody does want to jump in, is really just this this dominance right there. The UniV3 people, paradigm, etc. They, oh, Steven, yes, we want to hear from you. Exactly. Let's wait. Can we bring them up as a speaker? Bring Stefan up.
Yep, there we go.
Still see it as listener.
Yeah, you might have to invite him to speak, Zach.
Yeah. Well, while we're waiting, what I wanted to say was, this article came out, Paradigms, showing sort of the dominance of UniV3 in ETH markets. And I think this is really interesting, where you see like the public sentiment of UniV3 on Twitter versus like the raw data of the dominance it actually has in the market. And this, for me, is something really telling and very, very interesting. It comes back to my very first point, I think, which is that these market structures are not there to optimize for liquidity provider profits. And when you understand that, then it makes sense, right? Because everybody, and it's also not there to optimize necessarily for dev complexity, because the two biggest things I see constantly about issues with UniV3 are it's too complex to integrate, and it's too hard to make money as a liquidity provider. And potentially these things are true, but it's the DEX with the highest volume and the most market share and these best execution prices. And so to me, it's like reformulate, instead of just being like, the market's wrong, I don't get it, or this won't work, this is going to crash soon. Is like, understand why, what. So maybe actually the most important variable is just how you give traders the best prices, and liquidity provider profits maybe were never that important to begin with, which is just a weird thing to wrap your head around.
Yeah, it is weird, especially because like a lot of these yield farms like pretty much sold us the idea that we were supposed to make money yields on like providing liquidity, and I think that's still something that's done today. But I think all of us know at this point that that's at least not sustainable. I mean, maybe for a short period of time. So like, I'm a big fan of the like, give me as much APY as you can in 2 weeks type deal. Like I'm much more cool with that than just having like a continuous flowing stream that's never going to end of inflation.
Yep. Yep. Yeah, keep going.
Oh yeah, like I think that is important to me as a token holder, because it means like, to me, you're going to be smart about how much of your token you're minting the supply, and you're like, okay, we've got these early community members, we're going to give them 2-week liquidity mining, go. And like, that's cool, I'm totally down with that. I think when you start to promise more long term without adjusting for the market, I think that's when it, at least to me, becomes a harder sell of doing a constant stream of liquidity mining rewards. I think it hurts the image of protocols, because people sort of have this expectation of profit that's there, and then ultimately the protocol, the token, whatever, is not able to deliver. And it's just that's just kind of how it works. We have this split, I think, now between, and it's hard to tell when markets are going crazy. It's hard to tell what is the intrinsic value of a token, right? And like I think you brought it up that like the more liquidity that's available, that increases the value. I think that alone increases the value of the token if there's more liquidity.
Definitely, right? And then this is why these projects who launch the token themselves are willing to lose money on liquidity providing, i.e., provide these incentives to the LPs who they're outsourcing the liquidity providing to, or they can provide liquidity themselves and lose money on the impermanent loss. But either way, they're willing to lose money because they make money because the strengthened liquidity allows the token to actually fulfill its promises and thus potentially grow in price, right? And so it's like they're willing to lose money now to have a liquid market so they can make money later. Hey, we got a new speaker.
Oh, hey, it's Alex.
Yeah, what up? Yeah, I'm just here to try to fix the Stefan invite issue.
Okay,
Yeah,
thanks.
no worries.
Cool. Yeah, so to me, it's like to me, the idea also is it's not like liquidity providing, there can be profits in it, but the lowest level market structure is not where those profits need to be found, right? And even with the idea of liquidity mining incentives, right? That's something built on top of UniV2, right? You take your LP tokens and you stake them to get the rewards, right? And so to me, all the idea of profits for LPs, just like in centralized exchanges too, right? If you want a market maker to make your market, usually you have to pay them, or you have to have some options with them so that they're not exposed to the impermanent loss. And so what I really believe, and I think we're seeing play out right now, is that the profits that come for allowing your assets to be used as liquidity in the market, there is profit there. Why? Because for someone there's value for there to be more liquidity, right? So then there's a way to get some of that value for being one of these token holders, but that this is going to come at higher levels up in the stack. Unless you're some really, really pro market maker who knows something special, you're probably not just going to be vanilla providing liquidity to these decentralized exchanges and making a nice profit. And this is what Arrakis in the end is all about, right? We are this structure, this layer on top where you provide your assets to this Uniswap v3 market through Arrakis, and we help figure out how this is actually going to be sustainable and profitable, which has to do with more things than just the yield you're making on the trades on the tokens. So maybe and there's a lot of ways to innovate here, right? It used to be just liquidity mining, but now you see things as like one thing that's very well known is liquidity as a service. A lot of projects are trying to do this. And like stablecoin project will say, hey, we'll provide the stablecoin side of your token. We'll provide that side of the liquidity, but you're going to have to pay us the impermanent loss at the end, right? So these kind of deals, this kind of thing, there's going to be these extra steps in order to make it profitable for the LPs. And Arrakis tries to tokenize all that, abstract that away from you so that you can have this really exciting UniV2-like experience, just provide your assets and earn some yield. But under the hood, there's this more complex dance, just like in centralized market making that's happening, wherein maybe the project is subsidizing it with liquidity mining rewards, right? But maybe also the project is subsidizing the impermanent loss, more like in liquidity as a service. Or maybe you're buying options that the project is writing so that you can rebalance the liquidity in Uniswap v3 without impermanent losses, right? All these, there could be a myriad techniques, but there are going to be things that are beyond just directly interfacing with the low-level market protocol.
Yeah, and I think it's really cool that you guys have stuck around in this space for so long. Someone tweeted out this morning that like curse of the Uniswap automated liquidity providing protocols. Like there's also been Popsicle and
Charm and Visor. Yes, there have been many, and it is a difficult space. Exactly right. We often see this FUD, like, hey, all these projects are failing. But I'm very, very proud actually of how Arrakis has managed, like you say, to stick around. And we have more than 10% of UniV3's TVL on mainnet, more than 40% on Polygon, more than 25% on Optimism. So like, we're really I feel like we're really here to stay and are thinking in terms of the long game, and we have the TBL to show it. But probably one of the reasons is because we've been much more conservative about these market making strategies. So this was
I did notice, to piggyback off that, I did notice that a lot of the pairs, if I go on Arrakis, I think I was on Polygon the other day, like most of them are stablecoin pairs, which in the current market environment makes a lot of sense. I think, not financial advice, nobody has a crystal ball. I think we expect some volatility in the near future, but yeah, I think majority of the pairs, it also is like ETH and like wrapped Bitcoin, which again, those are the best performing assets during a bear market. Historically, Bitcoin was the best performing asset during the last bear market. So, I think the strategies that you guys have chosen, like, definitely have wide appeal. And I also know, like, before you guys became Arrakis, I also noticed, what was it? There was like a DAI USDC pool.
Yeah. And still to this day on mainnet, it's because it's a MakerDAO collateral type. We have a ton of, a large portion of our assets are in this vault. And this is because Maker whitelisted it as a collateral type, so you can actually go leverage into DAI USDC LPing on mainnet by borrowing, using your USDC DAI LP as collateral in Maker to borrow more DAI and thus deposit more USDC DAI LP and go leverage in this way.
Yeah, and I think that's the real power to highlight of the ERC20. Definitely having the NFT as like the base level in Uniswap, right? Like that was necessary. And again, like the key difference between ERC20s and NFTs 721s is ERC20 is like standardized, right? So like, if I have $1 in my left hand, $1 in my right hand, they can't be different things. There has to be uniformity to have this like fungible value that I can go out and buy anything, right? Or purchase anything. So then turning that back, making the NFT position fungible again, that enables you to deposit as collateral on something else. And I think you'd also highlight like get the liquidity or mining rewards and all like the fun stuff that came with Uni V2 is now like brought back because of like Arrakis, basically.
Yeah, and this has been our focus, is just making Uni V3 more composable. And I think that's where Uni V3 was lacking, but it's maybe okay because it's just, I see it now as this very low level protocol. And other protocols like us, I think will continue to see proliferation of things, building on top. And you can get these tokenized wrappers of anything. In the Ethereum ecosystem with the interfaces that we have. And so really, we focused on being the plugging into the composability of current DeFi, but having all the power that Uni V3 has. And we were just that middle piece, that Lego piece that connects the two. And so far it's really worked out for us.
Yeah, I think it's really exciting, like the approach and like the sort of, I don't know, would you say partnerships, like that to me was something that I was like, oh yeah, this is like a really strong approach that you guys are taking, because getting something accepted as collateral on a platform like that is, I think, a big step towards getting these like average person to be providing liquidity, especially on these more stable pairs. I think it makes a lot of sense. The unfortunate side is like, man, the yield's not going to stay around forever. You know what I mean? Like it's going to be sucked up after a while. But I think the TradFi guys just don't like the fact that it's not like fixed income.
Yeah, you don't know what you're getting, and they're not hedged,
Yeah.
right? And so, but the forward-looking thing for Arrakis is we want to have these auto-hedged products, and hopefully this will open the door for being able to go to a TradFi person and say, we can give you this kind of yield locked in. Why? Because we're hedged, right? We're delta neutral, so we're hedged against how the price moves. So you'll earn a steady amount even if the volatile price is moving up or moving down. You'll earn less than you'd earn if somehow you knew exactly what the volatility would be beforehand, because you're not paying the price of the insurance of the hedge, right? But you can now go over to TradFi and say, we can give you sustainable fixed rate income here, and hopefully this will continue to make UniV3 even more composable, allow more different kinds of parties to plug into this ecosystem.
Yeah, I mean that's the thing that always like stays with me, is that like the yields on Uniswap are the traders that come in, and they're taking one side of the market, and then the LPs are basically taking the other side of the market. And I wonder why, to some extent, there hasn't been somebody that creates like sort of a replicated market maker, so kind of just like mirrors whatever the traders are doing. Yeah, I'd be curious if something like that exists, and if not, like, why doesn't it exist?
Yeah, well, in crypto, you never know, and it might just be because we're too early, right? So maybe you can go make it exist. This is what I think is so exciting about working in crypto, is often an idea that seems trivial, and you go, wait, why doesn't this exist yet? You think maybe there's a flaw in my logic, but it actually turns out, no, just nobody's tried it yet, and it's a really great idea potentially. Right? That's how Ethereum was invented.
Yeah, no, that's very true. It's following the journey of Ethereum's like pretty crazy to know that like, so actually, if people don't know here, China was one of the first like heavy investors in Ethereum before I guess they became kind of outlawed because China wanted to have their own CDBC. Yeah, China was like one of the first like huge big backers of Ethereum. I think a little known fact there.
Quite interesting. I know. So I know we went on pretty long. I've got to piece out myself pretty soon. So maybe.
Yeah. Let's wrap it up. I don't know if anybody wants to come on stage and ask any questions. Otherwise, yeah, I'll just kind of like finish it off with what we're working on at Pool Sharks. So we are building a fully on-chain limit order book, and I if you guys have stuck around, you'll hear that I mentioned the term QMM, which is a queued market maker. So it means that at a given price, you are given time priority. So if you're the first person in the queue at a given price, then your order is filled before everybody else. This is different than a range order, because a range order, you have to wait for it to move through that whole price range. And one of the needs that I see that AMMs are not able to like truly fulfill is things that are outside of like the killer fill order type. So in our system, like the interaction doesn't just end with, well, I made a trade and either I got filled or I didn't, but you can get filled and then open up an order, and then like when someone comes and tries to take the other side, you're the first person that gets filled. So I think it creates a more like time ordered interaction with a DeFi exchange. And yeah, there's some really interesting properties. Like we discussed at ETH Amsterdam, the possibility of an order being transferable, and perhaps like representing like a future or an option or something like that. Like the ability to execute something at a given price, because limit order book, like the price is, in our case, the price is definitive. So yeah, there's been a lot of interesting ideas that have come out of us talking to people about the problems that we've been trying to solve. And yeah, I think it creates like something really exciting for people. I'm a little worried because the gas costs are not bad. It's pretty comparable with Uniswap V3. But certainly being a market maker is not inexpensive, at least on an L1, because each one's like pretty, like each order placement's like pretty much the price of like Uniswap V3. I think it's like 250,000 gas units. So it'd be like something like 2 swaps to provide liquidity or be the market maker each time. But the cool thing is that because it's time ordered, you actually collect the fees instantaneously. So you don't split them with the pool. You collect the fees instantaneously, and then you can kind of like move on to the next trade from there. So I think it creates a really interesting opportunity for a lot of people that are looking to get in this space as like MEV searchers. I think MEVers are going to go crazy over this because it's going to open a whole new like host of opportunities for them. And yeah, doesn't mean like people can totally front run this system too, right? Like you could just undercut somebody on price. But then you're taking a little more risk because you're selling the price or the asset below market price. So then like the person that's front running, they're kind of like taking a worse deal. So yeah, I think it creates some really interesting scenarios, and really interesting to see what people think of it as we get closer to like testnet and we have market makers, and then people can come and like play around with it. And yeah, like really curious to get everybody's feedback.
Yeah, sounds really exciting. Can't wait, and I'll be there. So let me know when you've got some live deployments. I'll definitely be playing around.
Yeah, we've already got a swap menu that's set up, so we just have to adapt that a little bit. I don't think everybody wants like the really crazy order book interface. I think there's some people that are probably going to be a little more tame and just want something more close to Uniswap. And yeah, we've already got that side built out.
Awesome.
Cool. Well, we're going to wrap this up. Thanks everybody for joining, and talk soon.
Peace out, everybody.
Adios.